You inherit a paid off house. What do you do with it? We're gonna run through three scenarios. Do you keep it and maximize cash flow with a paid off rental property? Do you refinance the property, pull out money and go buy another? Or do you sell the property and take the proceeds to buy more rental properties? Plus, we're gonna talk about a very important tax rule that may save this investor over 6 figures in taxes. Welcome back to another episode of Should I Keep My Rental? Should I refi it? Or should I sell it? So in this video, we're gonna run through the example I just talked about. And this is based on a real life scenario that I have seen here in Denver, Colorado. Hi, my name is Chris Lopez, and I specialize in helping real estate investors make smart moves with their rental portfolios by understanding it and then optimizing their rental portfolio. Now, before we dive into more numbers on here, I need to tell you about the tool that I'm using to analyze it. This video is sponsored by Property Llama software. Now, this is software I help co-create. Why? Because I need a better way, a better tool to go out there and analyze rental properties. So beyond getting current numbers of performance, the powerhouse is we can run scenarios of what if I did a cash out refi? What if I did a 1031 exchange? And the software can model it for you and give you side-by-side comparisons to help you understand, hey, if I did this, here's how the numbers look today, and we can forecast it out for years to come. So go to propertyllama.com/BP to go create your free account so you can upload your rental properties, get a free analysis, and see what potential you have in your portfolio. So let's jump into the first scenario of should you keep this rental property? Well, now I'm in the Property Llama software. And I'm gonna give you the background of the rental property and then look at the numbers today as a paid off rental property. So this person inherited the property recently from their deceased parents, and it's currently worth about $825,000. Her parents bought this property about 20 years ago in the early 2000s for about $225,000. Now, they bought it as a primary residence, not as a rental. So they lived there until they unfortunately passed away. But now their daughter has the property and she's trying to figure out what to do with it. So it's worth $825,000, but it rents for about $3,500 a month. Now that rent to price ratio is fairly low. Now there's two main reasons why it's a low rent to price ratio. One is because it's in a highly desirable neighborhood. 20 years ago, this neighborhood was not what it is today. Now it's like a very hot, trendy neighborhood where so many people want to move there. And the other thing is this is a 3-bedroom, 1-bathroom house. So only having 1 bathroom really puts a pretty hard ceiling on how much rental income this can achieve. Because if a family is moving into a hot, trendy neighborhood, they usually have more disposable income. They all don't want to share 1 bathroom. All right, but let's run through the numbers. So $3,500 of rent minus 5% vacancy, taxes, insurance, property management, and about 10% a year for CapEx and maintenance leaves us $1,925 a month in cash flow, or about $23,000 a year in cash flow. Now in isolation, an extra about $2,000 a month in cash flow, that's an amazing extra amount of cash flow every single month. But we have to look into what is generating that cash flow. That cash flow is generated off the $825,000 of equity in the property. I look at that as like the real estate piggy bank, and that has an opportunity cost to it. So I like to look at return on equity. And this is where we take the 4 ways you make money and we divide that by the total equity in the property. Now we're estimating in year 1, this is generating about $41,000 in return, coming between cash flow and appreciation. So that gives us a 4.99% return equity, or about 5%. So I talk about opportunity cost. If you're making a 5% return on $825,000, what's your reaction to that? Well, for me personally, if my return equity is below the historic stock market return, about 10%, I am personally not a happy camper. Now, there's another mindset in real estate that, hey, I have a paid off rental property, just keep it and enjoy the cash flow. Well, let's look at the cash return on the equity in there. So $23,000 a year divided by $825,000 is a 2.8% cash return on the equity. So is there anywhere else right now that you can beat a 2.8% cash return? Yeah, I mean, my online bank right now is paying 4.5%. I'm seeing CDs out there that are paying 5 or 6%. So if you want cash flow, there's other ways out there now where you can get a lot better cash flow without the headaches and risk of real estate. So this is part of the opportunity cost that you want to look at when it comes to evaluating a rental property. All right, the other number I like to look at is called cap rate. Now, cap rates are normally used to evaluate commercial assets, but it shows a good way about how the property is currently performing. So what that does, it takes the annual net operating income, which is rents minus all the expenses on non-mortgage debt, which is the same here since it's a paid off property, and divides it by $825,000. That gives us a 2.8% cap rate. Now, generally speaking, the higher the cap rate, the better return and the riskier asset you're going to be invested in. So if you know cap rates, you're not excited about a 2.8% cap rate. Now, my personal rule of thumb, when a property is below a 4% cap rate, it's time to sell. That is usually my personal indicator and a rule of thumb that I live by. Now let's jump into scenario 2, which is keep it as a rental, but then put on new debt, refinance out some money, and then go buy a new rental property. Now I'm about to run a scenario on here, but before we get the numbers, there's a key question I always ask myself and my investors, and that is, would you buy this property again today? So forget that you own the property currently and just ask yourself, hey, based on the numbers that I see, would I buy the property today? And if the answer is no, it's usually not a good idea to go out there and then refinance the property. So I'm going to run the scenario here and do the refi option. And we're going to get we'll get debt about 8%. We'll go out there and buy a rental property. And we're going to take about 50% of the equity on this property. So we'll keep it at a 50% LTV and then put a 35% down payment on a new rental property. So let's look at the side-by-side comparison here. And this models a year one potential return. So the left side is the current property as is. The right side is keeping a property and then buying a new property. So looking at return on equity, we're going from a 4.99% to a 5.12%. That's a rounding area and it's a lateral move. Now our total value is increasing dramatically. We're buying way more real estate. We're going from $825,000 to about $2 million. But look at this. Look at the cash flow. We're going from $23,000 a year in positive cash flow to about negative $16,000 a year in cash flow. Why is that? We're putting on high debt on a poor performing rental property, and two wrongs do not make a right. And so you can see down here, the current property that this person has will be negative cash flowing. And then the new rental property, even at a 35% down payment, will be a negative cash flowing property as well. So I definitely don't recommend this scenario. Now let's talk about scenario 3 of selling this rental property. Now, when you sell any asset, the first thing you want to do is look at your potential tax consequences. Now, at the beginning of the video, I mentioned a tax rule that could save this investor over 6 figures in taxes. So this is known as stepped up basis. So what stepped up basis means is when you inherit an asset, a piece of real estate, stock, a bond, the person inherits the asset, the value or the cost basis adjust. This often reduces the capital gains tax the person will owe to the IRS. Now, when you get stepped up basis, it comes up to fair market value. When her parents bought this property, their basis was around the $225,000 purchase price. Now, when she inherited it, the property is worth $825,000. That's the fair market value. So if her parents sold it while they were still alive, their basis would be $225,000, and that's what their capital gains would be potentially calculated off of. Where if she sold it, her basis is $825,000. Let this sink in. This person potentially sell the property and pay no capital gains on over $800,000. And this is with no 1031 exchange, it's just sell the property and that money goes into her bank account. Now, of course, I'm not a CPA, so make sure you go do your own research and talk to your CPA, but I'm giving you the high level points to keep in mind. Now, people often ask me, Chris, what would you do if you're in my shoes? For this property, I would sell it. And that's because we have the high stepped up basis and I could take a lot of the cash off the table. And second, this is not a good rental property. I would not buy this property today as a rental property. So let's dive into the options of selling it. Now, when you sell a property, you always want to look at who is the end buyer. So is an investor going to buy this, or is a family going to buy it? Well, most likely it's going to be your traditional owner-occupied family. They don't care about numbers. They don't care about real estate investing. They just want a nice place to move into so they can do their job and take their kids to school. With that in mind, you could sell the property as is and just say, hey, I'm gonna sell it. Let me get my $825,000. Or you go option B, which is what I call the fix and list. And this is where you fix up the property and then list it to get the maximum sales price. Now, what type of upgrades do you do to the property? Well, it's very dependent on what that local neighborhood will bear. Different neighborhoods have different exit points and they have different finishes that the owners expect. Well, since this is a 3-bedroom, 1-bath, it's a smaller, older home. Someone's gonna be paying top dollar for a house in a trendy neighborhood like this. They want a more modern and they want a bigger house as well. So to go out there and really maximize the list value, it's gonna take a lot of money. We estimate it would take about $300,000 in materials, labor cost, and plus some interest payments on taking a HELOC out there to cover all the renovations. Now, with that fixed up cost in there, the property would sell for about $1.3 million. So let's compare the two numbers, see what the best strategy is for this investor. So if we fix up and sell for $1.3 million, we'll subtract out the 6% transaction cost for commissions and fees. We'll subtract that $300,000 out for the repair cost, and that leaves us about $922,000. Now understand, we're gonna pay taxes between that $922,000 and $825,000. So that'll probably be about $25,000 in taxes. So altogether, you'd walk away with about $897,000 in proceeds. Now let's look at the as is. You go list it and sell for $825,000. And I'm subtracting 8% for commissions and fees and a couple points for just some concessions and some very basic fix-up costs. And you would walk away with about $759,000. Would you rather have $897,000 or $759,000? Well, you can't just look at those numbers compared side by side. You have to look at how much money and time and risk does it take. Is spending months and $300,000 worth the extra $138,000? I don't think it is. So my general rule of thumb for the fixed and list scenario is that for every dollar I put in, I want $2 out. So if I put $300,000 in, I want $600,000 out in gross difference when it comes to the sales price. Well, this scenario fails that 2-to-1 ratio. So the best option is to go out there and sell as is. Someone's probably gonna buy the property and then they'll spend $300,000 and customize it the way they want to. So this investor is going with option 3, sell the property as is. So what do you do with $759,000? Well, she's gonna take $59,000 off the table for some fun money and then donate to some charities she cares about. So this leaves us about $700,000 in proceeds she can go out there and reinvest. Now, it's really important to make sure we understand what her goals and situation is. Now, for this investor, she's actually a brand new real estate investor. So she wants to get into real estate, but she has really no experience with rental properties. The second thing is she is busy with a career and a young family where she has limited time. So with that, we want to make sure we can pick investments that match her goals and also fit her experience and her lifestyle goals. So I'm also a big believer in having diversification. $700,000 is a lot of money. Let's not just put down to one asset or one property. Let's divvy that up. So we came with a strategy of putting this into 3 different investments. So I'm gonna jump back over to Property Llama and walk you through those 3 investments. Now we're assuming an equal third investment. So the first investment is a turnkey duplex in the city she lives in. Now this is gonna be easy, low maintenance, and just a good long-term investment. Now maximizing cash flow for this investment, not her goal. She's putting down 35%. She wants to buy a good piece of real estate and then hold on to it for 10 years and then reevaluate. So this will cash flow about $3,200 a year and will give her about a 11 to 12% return on equity. So one of her goals is she really wanted to at least meet, if not exceed, what that paid off rental property would do in cash flow. And so one of our goals is to make sure she get cash flow today that exceeded $2,000 a month. Now, the turnkey duplex is giving some cash flow, but it's nowhere near that. And as you know, finding a high cash flowing rental property in today's high interest rate environment is really tough. So what a lot of investors are turning to passive investments with hard money funds. I like to call these as income funds. So you are investing the money with a private or hard money lender, and that lender is going out there and lending it to fix and flippers and other investors. So these are pure cash on cash returns. All you're getting back is cash flow. You're not getting back appreciation or debt pay down. You're just getting a cash return on your investment. So we're gonna take that $233,000 and invest it into a hard money fund, which will pay her about 12% a year in quarterly payments. Now, I'm actually modeling one that I've invested in myself, and hey, 12% on $233,000 is $28,000 a year in cash flow. Well, $28,000 is higher than the $23,000 a year she's getting from that paid off rental. So mission accomplished. All right, let's go into investment number 3 here. We got the other third of the money, about $233,000. Now, we've met her immediate cash flow goals with the income fund. And as we talked about the investments out there, she really likes the idea of owning real estate, but being more of a passive investor rather than an active investor. So she's going to take the other third of her money and go invest in a multifamily value add fund. Why multifamily? Well, because we've seen prices drop dramatically. Now, you may have heard some horror stories of syndications of these funds a couple years ago where some people have gotten wiped out. Well, that was when interest rates were low and prices were really high. Go look at the prices now of multifamily and other commercial assets. Guess what? They have dropped. So there's an old adage of, hey, buy low. So those properties are on sale right now, often being able to be purchased at 2017, 2018, 2019 prices. All right, so let's talk about the return profile of these types of investments, and you'll see why she chose this as part of her portfolio architecture. So year one typically has a 0% cash flow, and that's because the sponsor is going out there and finding the properties, acquiring them, rehabbing the units, and then getting new tenants in there at market rent. Now, by year 2, we start seeing some cash flow distributions, usually between like 3 to 5% in that first year, because quite a few units are rehabbed and rented, but there's usually still finishing up some units and getting new tenants in there. Now, by year 3, the property is typically fully stabilized, meaning all the units have been rehabbed, new tenants are in there, they're paying market rent, property management operations are pretty, smooth sailing. Now, a lot of times in years 3, 4, and 5, they'll be paying like a 6 to 8% cash on cash return. Where you make the majority of your money on these properties is not the cash flow side, but remember, this is a growth-oriented fund. You make your money when you sell the property. So we want to buy low, add value, and then sell high. So typically around like years 5 or 6, it's time to go sell the property, and you'll get a large chunk of your money back and a lot of your profit then on the sale of the property. Now, let's look at this from the 5-year perspective. So, we've got this long-term rental duplex. We're going to have a great asset and great location with decent cash flow. Just buy, hold, and keep it simple. We have the income fund, which is just giving us a 12% annual cash flow return. So year 1, year 2, year 3, year 4, year 5, you're getting $28,000 a year for cash flow now. And on the multifamily investment, year 0 is 0 cash flow, and you start getting some cash flows in year 2, 3, 4, and 5 to increase it. But you get your big win when it comes time to sell the multifamily. All right, so let's step back and have like a 30,000-foot view to compare these two portfolios. On the left here, this is the current inherited property. Paid off property, running $3,500 a month. We're getting our $23,000 in cash flow and 5% return equity. The right-hand side shows a portfolio with the duplex, the income fund, and the growth fund. So look at the return on equity. We have about 3x'd it, going from 5% to almost 15%. So remember, the higher the return on equity, the more future wealth and the more future income you are generally getting. So we're getting more future money, meaning that money is working harder today for us. And secondly, we're getting more cash flow today. We're going from about $23,000 to about $31,000 in cash flow. So we've greatly increased the cash flow, mostly coming from the income fund and then part of it coming from the long-term duplex as well. And of course, every year, we should see that cash flow go up a little bit as the multifamily fund starts paying out its distributions. All right, well, this video was jam-packed with numbers and concepts. So let's recap it. When you have a rental property, you always want to run it through the should I keep it, refi, or sell it scenario. And then you want to figure out two key questions. What can I do with the equity? What type of investments could I buy? We also want to sit down and revisit what your goals and situation is. Now, in this case, this investor want to be more hands-off as she's a busy professional. If you have a lot more time, experience, and you're more hands-on, you probably go out there and buy different investments. So let me know in the comments below, what would you do if you had a paid off rental property that was worth $825,000?